if I set this to my headset, it should pick up any audio that you guys talk as well. That way, whoever's listening hears all of us and not just me. It might have a 2 or 3 second delay, but it shouldn't be like a 15-minute delay because we turned off those, right? So it might have a little like latency delay, but it shouldn't be that longer term one. Yeah, that sounds about right. Right. I would call that latency. I know it's more than latency, but less than the 15-minute one. There's a delay setting that I went in and turned off so that it wouldn't be that long of a delay because they give you that option on YouTube to decide if you want a deliberate lag or not or delay. Some people use that for selling services, right? They'll have like their free membership, and then they people can upgrade to real time and pay more. So it's built in there, but I don't know why Kevin has it turned on, or if he might be running it through a program kind of like Restream, maybe not Restream itself, but something like it, and then he might not have that option. But he should have that option. It seems like they're coming out with new stuff all the time. I can't keep up with all the programs out there. I have not. Uh-uh. That's really cool. I just put it on. I found an indicator called dynamic order blocks. Not sure if that's what you was talking about. Yeah, they've always got really cool indicators. There are just so many amazing tools that have finally moved past the old school moving averages, right? Because it seemed like a decade of nothing but moving averages forever. Every new indicator was connected to a moving average for all of the 90s, it seemed like, and half of the 2000s. That they were just stuck on rate of change. That's what everything was made on. Then we finally started getting into some volatility tools, and now finally we're getting into order flow. I like it. I still trade with a naked chart, but having something like this up on an alternate screen would be useful. Just it saves you from drawing the lines. If you're like me, you got a lot of monitors, you got a lot going on. I a lot of times I don't even draw the line. I just let my eye see it. But this takes the strain off of me doing it, and we can see it without having to draw the line too. It's nice. I thought we would be seeing earnings just by using the earnings indicator, but they're a little too far out for Tasty. But we can go into financial services. That brings us up a watch list. It's not going to be, quote, banks per se, but as I mentioned, the banks are very illiquid. So, the request was looking at some banks with options, and most of those companies are going to have very poor options. So let's pull one up, kind of demonstrate what that poor option looks like. We'll do FLG first. We can tell it doesn't have a lot of good options because it doesn't even have weeklies. It's one of the first signals of a lack of liquidity. It's a cheaper company, less than $15, and yet it has $1 wide strikes. Typically, $1 shouldn't turn anybody away, but $1 on a stock that's not even $20 is it's kind of a pretty wide strike. Then we've got a lot of bag holders. We can see all of these 030s. They're all the same. And then 010, another 30, 30, 05. So really, we don't really got a lot of trades until we get all the way up to 16. All of this is trash. On the other side, looking at these are all trash. And it starts around $10. So we got a few more puts than we do calls, but not very many. A total of 7 strikes. Wow. And out of those 7, we can see participation. It's pretty heavy on the open interest for the puts. Not so bad. And for the calls, but no volume. So they have their position and they're just sitting in it, very likely not interested in moving. And for all we know, a lot of these are just uh, shoring up a position that they're holding. So they'll run with some default program that rolls them when it gets close to expiration, and they just constantly always carry these kind of positions. That's not helpful for us, especially if we're looking for liquidity. But it does show us that we could probably get out when we get near expiration. We'll start to get a little bit of volume for anything that's near the money or at the money into the last week or two. So if we own the stock and we want to trade some options against it, short calls, short puts, we could certainly do that. Just don't use these options to speculate. Don't buy a call or buy a put. It's not likely going to turn out well. The idea would be to defend your stock position. So if you buy stock, you could put on a stop, so to speak. Say we buy it today, $13.28. We could buy a 14 strike put. That gives us the right to sell our stock at $14 a share. We could, whenever we choose, we could manually put our stock on someone, force them to buy our shares, whether they like it or not. But it's not free. That's going to cost us 80 cents if we split the bid and the ask there. So if we bought it at 13.28 and then we spend 80 cents on a put, our real risk out of pocket is $14.08. So this trade would be, I could buy 100 shares, I could buy that put, and my real risk would be 8 pennies. Well, that's not bad. I mean, I don't like to lose, but 8 pennies doesn't really sound all that scary. This gives me a chance to be long FLG, and my quote real risk would just be that 8 pennies. The problem is this option is going to expire in 16 days, and then I wouldn't have any coverage. And then I would have to go out and buy another put, and that is going to increase my risk because that gets added. So rather than buying one and then buying another, we could just buy one farther out in time, or don't buy one at all until you think you need it, which, unfortunately will make your put a little more expensive, but it's better than just carrying this perpetual long put all the time. Don't get me wrong. I know a lot of traders who do that, they consider trading without protection to be too risky, and they do it for every single trade they take. It cuts into your profit on the one hand, but it makes sure that you have a good trade to begin with, or you just won't put it on, because these puts are going to force you to hold that trade until you get a higher profit target, right? If we buy this right now at 13.30, I need the stock to go at least to $14 for me to make break even. I wouldn't even start to see profit until we got above the value of the put that I paid for, right? So these 14 strike puts, 44 days out, split the mid here. It's $1.07. I would need the stock to go to 14.35 ish before I hit break even, and I would need to get above that to even start to see profit. So when you look at it and you think, oh gosh, I don't know, I was just going to take a 50-cent move. Not now. Now you're going to need $1.50 move just to see a little bit of profit. And if you don't think you can get $1.50 in 44 days, then you just leave those puts alone. Probably just leave the stock alone and move on to something else. It has an expected move of $1.27. We need $1.50. That doesn't sound very good. Probably want to let that ride. Find a cheaper put, or find take a little risk. We don't need the 14 strike. We could buy the 13 strike. It's cheaper. That would allow us to sell our shares at 13 after we bought them at 13.30, and then we paid 57 cents for the options. These are not penny wide options, so we're going to have to actually pay 60 cents. We can't split the ask. Even though it says we can, you can see from the trades, it's running nickels, so it won't fill at 57. It very likely won't fill unless you get to 60. So 60 plus the 30, that would be 13.90 as our break-even price. And if we took assignment or exercised our right and forced the puts on somebody, we would lose 90 cents. That's our max loss. And again, I don't like to lose, but if I know for sure my loss is capped at 90 cents, I'm okay. So that's better than a stop. If you're comfortable with the downside and you just want to enhance this stock trade with some options, then you could consider selling a call. It says we have $1.27 to the upside. So if you sold a call, that was $2 out instead of $1.27 out, you could enhance your stock trade by an additional 20 cents. I know it doesn't sound like much, but this is a cheap market, so can't expect a lot out of it. The main thing is, if you want to trade banks, the options are really sad. So you just have to come to terms with that. Generally speaking, the way I trade, I won't compromise my rules. If my rules say I need liquidity, then I need liquidity, or I just won't trade it. But banks are going to kick off the new earnings season, and behind banks, or after banks, you want to say it that way, is going to be the Mag 7 group and all the software and all those guys. So it's a good question to think about, and it's a good time to be thinking about it, because it's coming 2 weeks at most, and we're going to be into the earnings season. If you trade earnings, you really want a lot of earnings data. Maybe get something like Earnings Whisperer or Whisper Number. There's other places and use AI as much as possible. Talk to it about your company's stocks, the peers, the short interest, how often they like to dilute the shares. Get as much information of the company that you can get. Net interest income is one thing that banks get punished for. That number is like their widget. When it comes to car sales, Tesla, or with Meta, it used to be how many members were on Facebook, you know, whatever the widget is. So for banks, that net interest is usually the number that people focus on, but there's other metrics, debt, if they've recently merged with another company, another bank, that sort of thing. Now, we didn't have a list of bank names. And with modern banking, or a lot of these things like Affirm, there's some real choices out there that don't necessarily fit into what we would consider the old school banking regime. It might be worth looking into those, right? Or just looking into the big dogs like JP Morgan, Citigroup, Wells Fargo. They're more popular and likely have better option choices. So let's take a look at some of those. And remember, it's all going to come back to yields and their earnings. So if their earnings are poor, most of the market's earnings are going to be poor because they're the bellwether. If banks have a bad earnings, everybody's going to suffer. So let's see, we'll put on banks. That is not what we want. So let's customize that. Should be able to run market cap and then sort by cap. The big ones should come to the top. There we go. Morgan Stanley. It's holding above that 50, but like a lot of things right now, notice they all have eh, this same setup, most of the market. So banks, technology, they're all in this sort of a bear flag pattern or bear pennant. And we're all looking to see if we're going to turn into a cup, maybe get a handle and then continue on, or if this is going to turn into more of like a bear flag where we continue on afterwards to the downside. I'm going to detach this list so that I can look at Tasty. All right, got a lot more choices. Got the W showing that we have weeklies. We can see the earnings highlighted with that purple line, April 15th, tax day, I believe. I want to go out at least to April. It's a comfortable zone for me as a good starting point. $5 wide strikes. It's a signal of illiquidity. We got a $15 expected move. The bid ask spread isn't horrible. I mean, it's not awesome, but we've seen worse. 30 cents, 70 cents on the put side. There's just the volume is really low. The thing is, the volume might be low because of how far out we went. 44 days. I mean, that doesn't feel like much. But if we look in the front end to ask the question, can we get out if we do get in? Wow, there's nothing here either. So, not overly excited about Morgan Stanley for an options trade, unless, of course, you're buying the stock, but it's $165 a share, and you would need 100 shares at least to be able to sell options against the shares that you bought. So, Morgan Stanley, nah, those options don't look good. So, how about Goldman Sachs? All right, earnings on the 13th instead. Do we have liquidity in the front end? Triple digits on a few strikes, really low open interest on both sides. That's just horrible. That's worse than Morgan Stanley. Yeah, that's bad. $5 wide bid ask spread. My goodness, I don't even know how that has weeklies at this point. So Schwab, I'm in a number of these brokers. I've been in them for a while now. I think I've got ICE, NASDAQ, a couple others, but it was part of a package trade that I put on a year ago, a year and a half ago, when brokers were doing really good, especially ICE. They started offering a whole new product to clients, and ICE stock was doing great. They were grabbing a bunch of commissions. Their stock was doing good. I think all of them now are kind of beat down. So see if it's liquid in the front end. Earnings on April 16th. We've got a little bit of volume. One strike that has over 1,000 in open interest. It's probably the same person on both sides. Otherwise, not a lot of volume. That's today's volume on those puts. Check that out. Let's dig into this. Schwab, 90 strike puts, 9 days out. Surely they're not trying to trade 9 days out, but they might. What product do we want to use? All right. These are the outrights. Um, just straight up trades that were done. Nothing complex. These are sweeps. We want to get into something a little deeper than that. Some options. '90 strike, April 10. Here's April 10. Now, the top open interest, which comes over from yesterday, was the 90 strike in May. If they're building that position out yesterday, which is why we see the changes reflected in today, it's likely that they're selling their April 90 strike now so that they can work on that number and continue to build it out. We want to see more of that, though. '90 strike puts. April. It's yellow, though. Yellow's not helpful. Can't tell if they were selling them or not. So they have been coming in all day and hammering that, and it looks like it started this afternoon. Gonna look at some time and sales. So this is the kind of research that you want to do, right? When you're trying to figure out what's it been trading, what side are they hitting on, are they buying them or selling them? You just play detective, right? Start digging through April 10, 90 strike puts, although I didn't adjust it for which strikes. They're definitely selling them. It looks like they're moving over to the May 90 strike puts. So it's probably a roll. They're getting out of one and getting into another. Or they started yesterday getting into it and they left these on to be taken off. So we can look at May. Why are they using an off day? Probably waited for JP Morgan's order to go through. Okay, we're looking for the 90 strike. Now they got into it yesterday. So they didn't roll them. They went ahead and left them on and opened new ones for May. And now they're slowly taking off the ones for April. That's not helpful. They're just carrying puts, right? I know it's not a popular idea, but trying to use options data to determine where the stock price is going to go, you can do it. I see on YouTube or Twitter they talk about it all the time, like it's a foregone conclusion. But you got to have really shining lights, flashing lights, something that says, "Oh wow, look at this! They've put in 1,000 orders, and every one of them was, 900 contracts," and it's like this big flashing light that says, "We're getting long in this," or "We're getting short in this." But you don't get that most of the time. You just get some muddy water with a bunch of mixed trade signals, and at the end of it, you look through all of it, and you really don't get much out of it. The best data that options can give you consistently is support and resistance rather than momentum and trend. So focus on where the large amounts of open interest are at, and that can help pinpoint your support and resistance levels for the larger time frames, right? If you're looking at April and there's a crap load of options at 90, then if we fade down into 90, we're going to have a hard time getting through that level. That'll act like a support level. Right? It's pretty generic, but it works a lot. So that's a good approach. And it's way more consistent than thinking that we can use the options data to highlight bullish and bearish markets with momentum or trend. It is doable, but it has to be clear, clean, obvious data. And this close to earnings, when so many people are positioning out, it won't be clear and clean. So here's our open interest. We got the calls and the puts, all expirations, and we can look at where the greatest position size is and then where it is. So in time, that's January 2027, and the strike location is 72.5. It's a long ways out on the call side. $72. That thing is deep in the money because we're at $93. Or on the put side, we got this one way out June 85 strike, and it's the largest one. Man, PayPal, such a disappointment. You guys remember the Carvana talk that we had? It was this beaten down chart that makes for a really great reversal trade. Let's see if we can demonstrate what that looks like. Because I think it was a great example of a chart you guys always want to find. And PayPal was setting up a lot like this. So we use Carvana as the example chart. This is a swing trade chart that when you find something like this, you really want to focus on it. Let me zoom out. This is what it ended up doing. Carvana had this steep crash decline from, like $375 down to, I don't know, $1.75, something like that. It was really cheap. And then it climbed all the way back out. Right. So obviously you want to be a part of something like that multi-year run, you know, eh, massive profits. So you want to find things like this. When we were focused on PayPal, it started to have this same setup at the time. So first you need the steep decline, breaking underneath that 200-day and then falling really fast, outrunning it so much that it makes the 200 slope down steeply. You need all of that. Then once you get down here, you want a long base. There's a market truism that says the wider the base, the higher in space. This based for a couple of years. And you can see, I mean, it ran back up and it tested some levels, but it was down here for a while. And it was down here for a considerable amount of time too. So eventually it crosses over, right? We begin working our way back up. Um, there was a short report that came out from, that company that they're not around anymore, but there was a company that was Heisenberg, I think it was called. This company was known for their short reports, and man, when they would hit a company, it would be so convincing. Everybody would just short that sucker. And maybe later the company could prove that whatever was in the article wasn't true, but usually it was pretty spot on. So they got hit with a short report. And then I believe there was bankruptcies and a change of leadership, and that's what caused the drop in the first place. Then down here, I believe it was a father son deal and an activist investor that got together, and they restructured the bankruptcy and started working on resolving the debt, and they worked their way up the other side. So the underdog story really helped when after it was down here and it was trying to climb. The activist investor certainly helped. The father son team duo, everybody loves a good story. All of that helped the narrative, and it started to get a bit of a cult following. But at the end of the day, you don't have to have the narrative. And the activist investor was nice, but we've seen the same move without having an activist investor. But this pattern, when you find it, put those kind of stocks on your list, because if they start to slowly climb their way out, I mean, you got time, right? It's not like it happens in a day. You can put that on your radar and you can start having lines in the sand for where you might want to begin adding in. And when they're really cheap, $3, $2, you know what I mean? You can throw a couple hundred shares at it, and like, worst case scenario, it falls back down and maybe turns into a pink slip, or it just disappears as a company. Fine, that happens. You write it off, you move on. But a lot of times they'll either stay down there and you're bag holding for a while and then you just dump it, or it begins to perform. One of the first, right? That it's a good one to keep your keep your eye on is when you've got a beaten down stock and it's building a long base, put that thing on your radar. So some of the things that you can use for kind of like lines in the sand on when to add to something like this is when it gets above the 200-day moving average and stays above. Now, just, when do we say okay, it's staying above? When it crosses over at any point it could come back down. So it gets there and we're like, well, I don't know, it's above. Should I buy some? Sure, why not? Maybe you buy a little bit. And then after it consolidated there for a while, it broke out and it started to run higher. I've had people say, when do you buy stocks as they're going up? And this is a really good example of when to buy stocks when they're going up, because it's proving your theory correct that it's continuing to rise. It's really cheap. It's coming off from being a beat down, dead end, nothing company. And of course, you want to keep your eye on headlines and news and who's participating and all of that. Definitely know the why on why did it fall, but this is the kind of trade that you do add as it proves you right. Then, you get the beat down situations like this where they shorted it into earnings and yet earnings was fine. It didn't crash and burn. They got through earnings, rallied back up, and that whole time it held above the 200. So, as long as it continues to prove you right, you could consider adding a little bit more. It's a good way to play as opposed to something, say, like Google or Microsoft or some big name worth hundreds of dollars with really expensive options. I don't tend to buy those as they rise. I tend to sell out of those as they rise. It's not always just the way that the chart looks. Sometimes it's how much it costs. When it's really cheap, I'm willing to give a little bit of leeway. Or if there's a idea behind it, like I've still got this pot stock, and granted, I've got a very small position in this ETF, MSOS. I still firmly believe that eventually these pot stocks are going to begin to do well when legislation changes. I picked up those shares. This is an average price because I've been buying on the way up, and bro, right now it's really down. That's not helping me, but I'm not going to add to it while we're down here, and I'm just hanging on to it. But it's just one of those that that one has a story, or at least a future. I think pot stocks do. EVs was another one. Those air taxis is another one. Air taxis, the clock is ticking on those. I really think they've got a future when 2030, or maybe it's 2031, because they've all got a 5-year contract right now. Either they're in the United Emirates or they're down in Brazil or there's another one somewhere else, and they're running air taxis right now. And after that 5-year contract, I really think they're coming to the US. As long as they don't kill anybody or have some really negative publicity, like some big disaster where maybe a lot of people almost die. As long as it's not something like that, I think we're going to start to see air taxis. And those drone companies that are doing air taxis, those companies are going to start to really perform well, like Joby and EH, right? And those guys. Right now, I mean, they're toast, but um, yeah, yeah, because yeah, in the United Emirates, their buildings, they got all those brand new tall buildings, and they're using the drones to basically building jump. All your friends are at a party on the next high rise, and they get in their sky taxi and they just puddle jump over to the next building. And as long as everything goes good, then everything should be fine. In Brazil, they're doing tours. Both companies that I mentioned are Chinese companies, and they're building out all their own infrastructure to charge the vehicles, to perform maintenance. Like everything is being developed by the country in and the name in that country. So Yeah, Archer. Yep, Archer's another one. I had a whole list of these and I did a lot of work on it. I posted it in the chat probably a year and a half ago, I think. If we was to scroll up, might be able to find that. Um, and maybe some of the names are gone now. AQNR. I don't know that one. Let me see. I I don't even have that as a symbol. Yeah, that's what I was saying. Yep. It's gonna be a big deal, and then you have to figure who's gonna win for say, the plugins. Just for an example, who's gonna have the plugin that all the other companies are forced to use? That way, they're not each running their own plugins. There's so much that needs to be resolved when it comes to that space. But I am a firm believer that it is coming. That by 2030, maybe 2031, if these companies don't have some really bad news, it should turn out well. I'm looking for my note list. Um, I've got it on a different platform other than Discord, so maybe I can view it. No, can I print it? Let me print it. That'll work. I obviously printed it once because it is in the Discord. Well, that didn't work. Okay, that works. Ah, drone technology. So it's my own little research that I had put together a while back. I used news articles, headlines. I talked to AI to help with some of the years that the companies were made, or if they did a name change or merged. So AI helped me with that. Otherwise, I was trying to break it down into different kinds of groups because drones is just very vague. There's military drones, supply drones, shipping, hel- um, medical drones. There's just light shows, all kinds of stuff. So I was really trying to break it down into which ones were more commercial taxi style drones. And if they had picked up any contracts, then I tried to add that to the list too. So we got Archer on there, Joby, EH, um, and a lot of these guys do have good contracts, like the United Arab Emirates with Joby, and I believe EH is the one that's down in Brazil. So that's the kind of idea that I was trying to point out when it comes to having some stocks to keep your eye on. They might not be the most glamorous, sexy things that are moving at the moment. Liquidity might be a little bit of an issue, but there's a theme behind it, or a narrative, or some idea for why that space, maybe not that one name, could continue to do good or start to do good. Sometimes they don't last long, like drones got hot for a little bit and then they faded, or quantum comes and goes. It gets hot and it fades. Those SMR reactors, it comes and goes just like pot stocks. It doesn't last. But eventually, if legislation changes, these air taxis are really going to perform well. If legislation changes, so will pot stocks. So, you can try to time it, or you can just slowly build out a position as long as it's performing well. And then, of course, I dug into different components. Um, because if you want to get into a particular theme, then you can break apart the trade into different pieces, charging stations, or the cameras that it uses, or the satellites that it connects to, who's their data providers for navigation. There's so many ways to play those kind of trades. So Carvana is a really great representation of a fallen angel or a comeback kid. It's a great story, and it's a great chart to focus on as an example of the kind of beaten down recovery plays that you might want to do. So I was looking at PayPal back in 2023, 24, and it had that significant beatdown and then the base. And so in 2024, kind of jumped the gun a little bit. I was like, we're going to go up, baby. I think this is the year. And it slowly ground its butt up for most of the year into 2025, and then back down it went. And it was just, what a turd. So now here we are in 2026, lower than we've ever been before, back below the 200, setting new lows, dancing around $400, and we're still dealing with a market that hasn't recovered yet. So, maybe this is an example of a failure where it just didn't work, but all the components are there. Swift beat down, wide base, it got above the 200, and it was setting higher lows. Everything was doing good. Even this break of the 200, there's examples on other stocks. I don't think Carvana broke the 200 that bad, but there's other examples of this same setup where the 200 gets broke. Even that one didn't really bother me that bad, but this last breakdown here below 50, that's it right there. I'm done with PayPal until it can start printing higher lows again. Right. There's a long history with PayPal and its different owners. Musk was involved in it, including his company X. I know everybody knows Twitter as X, but back in the day, he had a financial company called X. And then there was eBay was connected to PayPal, all of it back then. What a mess. There was a really fun video on YouTube that goes into the history of PayPal, and not all the history is good. Like they can't account for how some people are using the platform, sending money without accountability. They were worried about criminals using it for that. They've been known to shut people's accounts down and then take months or years before you can get your money out of them, and never get a good reason for, hey, why did you shut my PayPal account off? Like, that's some bad practices. So it's not all good, to be sure. See if I can figure out what was the last straw on that beatdown. That was what, 2021, wasn't it? Yeah. So it doesn't always work out, to be sure. The recovery's not there either. Okay, it decoupled from eBay in 2018, and then um, it really got juiced up during COVID. Everybody was at home and they were using different financial services, and PayPal got lit during all of that. You can see that run up. Then competition from Braintree. came in, and it had a leadership turnover in 2023. But really, it just looks like it got ahead of itself back in 2020, a lot like Zoom did, and then it took a beat down afterwards. Wasn't spending the money well, just like Zoom, and just kind of steamrolled into crashing and burning. Apple Pay, Google Pay, Zelle, a lot of competition stepped up, challenged them. They weren't able to manage. So at least, we didn't find something really bad. Like they weren't stealing things or tricking the books. Like those are the kind of financial reports you don't want to find. So really, an appropriate price tag for this thing is probably somewhere around the COVID price, where it was before COVID came in and ramped it around 120, 125, because it was during that whole COVID thing that it really just got out of control. Considering we're sitting in the 40s, we got a good 80-point move ahead of us at some point, or we're in the six. Yeah, we're in the 40s, but I'm disappointed in it. So for an example of, the beaten down wide space, bring it back up, PayPal is an example of it not working out. But you can always use Carvana for an example of what you should be looking for if you're looking for a fallen angel. I don't tend to focus on this style of trade a lot, but you got to keep things changing up. Yeah. I zoomed in to get the low. I found it $3.58. That that is not bad at all. You know, low risk, but it was it was a leap of faith back then for anybody to buy it at the absolute lows because we wouldn't have known at the time, right? It was still falling. It hadn't even set a higher low yet. It was still falling, still falling. Buying it at that price would have just been a pure leap of faith. But after it had started to climb out, $5, $10, and definitely once it got through the 200-day and then broke that last high, an argument could be made. Yeah. It de- it depends on the exchange. They have different rules for each one. Yep. Yeah. The Nasdaq has looser requirements. So I wanted to say stricter because it has a lot more turnover, but it's because of the looser restrictions that they get sloppier companies and then they do get more turnover. So it's kind of a catch 22 there, but every one of them. So what you'd want to do is go in and research each of the indexes. The Dow is really strict, 30 names, blue chip, best of the best, and it has a little bit of a turnover, but those names, for the most part, tend to stay there. And then the NASDAQ, which is actually a newer index, all things considered, it has less restrictive guidelines. And so names get more leeway there. But that means we get sloppier names and then they can't sustain it and they get removed more often. Off the top of my head, I don't know what are the restrictions for each of the indices, but that's what you'd want to dig into. And that's where AI really excels. Asking AI those kind of questions, I love asking it that stuff. That and Google Scholar is a good place to ask those kind of questions. The other thing on the list today was utilities companies. And again, that kind of space is a real illiquid space for the most part. I mean, kind of pick and choose a little bit, but it's not as liquid as you would want. So we'll go in, look for industry, energy, utilities, electric, gas, multi utilities, water, independent power, renewable energy. We'll say electric and then sort by market cap. So knee energy is really big. I always lump knee in more of energy storage, but whatever. Uh, they've got it under utilities. We'll look at it that way. The It's not the first time today someone had me looking at knee energy. I mean, it's holding up well, but if you look back, we had this consolidation and then it dumped out. Another run up and a consolidation. Maybe it's the same this time, maybe not. It's under the weather. There's another one of those market truisms that say if 80 then 100. I know it sounds glib, and you hear that and you think, well, who would believe that? But man, it holds so true a lot of times. And if it fails to reach 100, the market eventually gives up and will take it back down below 80. So, we've got this previous all-time high back here where it failed to hit 100 and the market beat it down. And now we're making another run at it, and it's taken a couple of years to make this run, and we're back to that same level. If it doesn't make it through here, I think the market's going to kick this thing in the face again. Below 80 at least. So we got a weekly chart here, and the boss candle, this one right there, is what we have to get out of at the moment. That's the candle in charge. And of course, you can just measure the whole range. And that top to this bottom, we're above the halfway point, which is like, I don't know, call it 93. So as long as we're holding above that, we can challenge this candle's high, come back and challenge all-time highs. But the energy space with all the headlines and the news, um, there's going to have to be a lot of rebuilding done. We don't know how much everything is broken. It's going to take a long time for energy to be resolved, and the crisis still isn't even over. So they're not even rebuilding yet. I would be careful with all energy plays, whether they're utilities or not, unless you're looking at like municipal utilities. But that wasn't the way it was asked. It was just utility companies. Yeah. So like say California and Los Angeles, they can run bonds on the monies collected from the customers that they have. They can take that money and invest it, and then you can get bonds. People, it's like you can buy the bonds, so you're basically loaning the company money, and those bonds 4%, 6% interest. It's not quote risk free, but it's really low risk. It's everything is good as long as the money is managed well and the fund doesn't do anything silly. But we go through years where price stays steady in those bonds and nothing moves, and then they quit carrying protection or they over allocate, and then all it takes is something like COVID to come along and wipe a lot of those bonds out, and then of course they're broken and destroyed. So you can, if you're looking at municipals, you want to look at the bonds on municipals, not the actual companies. Right, for the most part, yeah. definitely a heavy hand, kind of like Freddie Mae and Freddie Mac, how the government was basically owning those for a while, but they, kind of the same thing. This is Public, which is a great broker that I like to use for bonds. And if we go in here and look at assets, let's see where I can find just bonds. I don't have any bonds on my list, so maybe not there. Bonds, 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 bonds. We would be able to look at municipal bonds and pick the region that we want to, East Coast, West Coast, and start narrowing it down. That's one way to do it. You could try to focus on the companies, but most people that I know that's messing with municipals, they're running through the bonds themselves, not the companies. And or that it would be based on the city, right? And it's not like you can buy LA, but you can buy LA's bonds, muni bonds. I wouldn't want to buy LA. The muni, the muni bonds, the muni bonds, the municipal bonds, water, electricity, the municipal bonds. Yep, absolutely. I don't come over here enough. I'll tell you, the last time I came over, I had a nice little pop up and it said, "Do you want to look at bonds?" And I said, "Yeah." And it just took me right to bonds. Now I'm dancing around all over the place trying to find what I'm looking for. So these are the corporate bonds, but we're looking for the municipal bonds. So we're not going to find it in here. It didn't give me municipal on this. Corporate bonds is all I'm finding. I could very likely log into Schwab on the website and bring up municipal bonds. See if I can get them at Schwab. Kind of. Over the years, we've had affiliate links with various tools out there. No, nope, nope, nope. I get it, but nope. The more you go on, the more you highlight the why on the no. It's such a massive ask that nobody is ever going to sit there and want to work out an encyclopedia of tools so that we can offer it to our clients. Ask Kevin makes, maybe he'll prove me wrong and he'll want to spend the next 5 years developing an encyclopedia of tools, but I certainly won't. 2 hours wouldn't even come close. Not even close. In your own head, sit back and just rename the things that you just said in a minute and a half, and 5 tools for the things that you just named in a minute and a half. We wouldn't even be able to get through that list in a 2 hour. You know what I mean? Just one product. That's why we do a video on one product. So that if somebody goes, "Well, I wonder what TradingView's got." We got a video. I wonder what Schwab's got. We got a video. The problem with trading is there's so many aspects, right? Not even just the tools yet, just trading, futures, stocks, options. So that when we go in, we'd say, I think I'm going to be a trader. I know that's what happened to me. I thought trading meant stocks. So I get saddled up. I'm ready to go. I join the Bullish Bears. Everybody's talking options and penny stocks back in the day. So I don't want to trade pennies. That looks like trash. And options, yeah, they're a little complicated. So what do we trade? So we got to figure out what we're going to trade and then what tools are out there. So then we got to pick a broker. There's really not a lot to choose from, although there's a ton of brokers. Most of them aren't, quote, tradable brokers. They're places like Fidelity, where you can enter and exit a trade, but you wouldn't want to spend all day on Fidelity as a trading platform because it sucks as a trading platform. So we just work down the list. We got to teach people these are the things that you can trade: stocks, options, futures. And then now we need a broker. Are you going to be a trader, or are you just going to be pretty much a bag holder, a long-term investor? If they're going to be a trader, there's not very many brokers to choose from. There's that list, especially if you don't live in America. If you don't live in America, the list is usually one name, IBKR. So there's that list. So now you've chosen what you want to trade and what broker you're going to want to trade. And then we need a tool. There's really specialty tools for futures and specialty tools for options because they're complex. Other than that, the quote specialty tools are things like Seeking Alpha and Tip Ranks and Investors Business Daily because they're the quote stock guys and they'll do fundamentals and look at the background of the company and its earnings and all that stuff. And any of them are as good as any of the others because it's just background data on stock companies. There's not a lot to it other than the trader themselves growing into what tool do I want to use, and then hoping that we got an affiliate link so we can get it cheaper than having to pay full price for it. But if we try to do a search just generically, we'll find a whole list of stuff. Ask Kevin, maybe he would be interested in doing it. The worst thing I think would be that nobody would have the journey. Maybe that's kind of a sad way to say it, but I learned to be a trader by learning. And if I have some video that gives me, you look at this broker, you look at this stock, and you do this right here, and then you pull the trigger when it turns red, and you pull the trigger again when it turns green, and you're done. And hey, you're a trader now. Go to the golf course. I didn't really learn anything. I better hope that tool never breaks or that the company doesn't change. Then I don't have my tool anymore, and I'm gonna have to figure out some other button to push. Oh yeah. A lot of these tools though, they're the same as something else, right? Like finance juice is like the market edge, spot gamma is like Volland, IBKR is like Thinkorswim, trading views like Thinkorswim. Nuanced differences for sure, but it's going to show you charts or options or futures, and then it's going to be an order flow product, right? There's not a lot of variety other than where the buttons are and the pretty colors. The variation doesn't really change that much. I try to focus on, for the most part, things that I know are free or that you guys can get cheap, or especially with an affiliate link that really knocks the price down. That way I don't show you guys stuff that is crazy expensive or crazy complicated. That's why I hardly ever go to Volland, because those $1,000 a month is a bit much. Right? It's asking for too much. So I try to keep things that are cheap or free, and that just because they're free still have really good value. This tool that I brought up is a broker public, which I've talked about before, but this is what I recommend to my in-laws when they wanted to get into trading, but they don't want to learn how to trade. They made that very clear. They wanted to trade, but they didn't want to learn how to trade. I sent them here. This has recommendations built in. It will allocate money from your bank and buy whatever you want it to buy. So if you want to like build your own retirement with SPY and the Qs, you can get an account here. It's free. You don't have to buy an account. You can get an account here, and you can tell it every Friday when I get paid, grab $50 out of my account and buy SPY on Monday with it. It'll do it. Or you can, buy all the Mag 7. It doesn't have to be one name. You can fill it up with a list of names, and it'll buy fractions of a share. So you can tell it, just take $10 out of my account every week, and on Monday, buy into whatever. It offers stocks, bonds, options if you want to, but I wouldn't recommend that. It's just, at least not to my in-laws. So it's a great, great tool. Right on. That's a good way to go. Um, I know I'm not back to flat. This platform I started with around $100, built it out, and then I pulled funds out somewhere. I think it was right somewhere around here. I pulled money out, had a big payment, and everything else that I'm in is diverse. Lots of stuff in this one. And I had it on a buy schedule for a while where it was auto buying into a bunch of stuff. I turned all the auto buy off, and I've just been kind of sitting in what's left. It's spread out, got Amazon and Apple and Google and Nvidia and Tesla and all those guys, but it's got healthcare in it, Arc Genomics, some bonds, the dollar. It's pretty diverse, but it's not really holding a lot. The size of these positions are really kind of small at the moment. But it was just $100 account that I grew out. It was over $2,000 before I pulled money out. And then, of course, if you noticed, it's been bleeding to the downside too, because I'm not doing anything. That's year to date. since the first of the year, I haven't made any money in this account. That's 6 months, 3 months, 1 month, 1 week. Yeah, they're all going to be down. But 1 year, there was my climb up. I don't see my withdrawal anymore. It used to stand out. Year to date. No, 1 year. That's not year to date. 1 year. The last year's gains are gone pretty much in that. But I'm still above my $100. It's at 1536. So my $100 got me pretty good. And I should do something with this account. I really should. But all of this profit is based on my $100. And for the most part, the names that are in here, other than like the Joby, the Archer, there's all my drone names. A lot of these are long-term plays that I think need time to play out. So I'm just letting them go. Quantum names are in here. My broker plays are in here, like ICE, NASDAQ. So I guess themes. If you want to, if it needed a name, that would be my themes broker. It's a good one to go to for themes because you can build out your list, name it, and then tell it how much you want to allocate. I was pulling $85 a week in total for all of these different themes, and then it would get the money from my bank, and it would come in and s- buy more shares of the same whatever I had told it to get. Artificial intelligence, the Mag 7, brokers, drones, and quantum. That was my 5 themes that I was running in here. Good way to go if you got themes on the mind. And you don't need an account here, a paid account. You can buy a paid account. It'll get you better bid ask spread. I think you get some option privileges that are a bit more advanced. I think I'm not sure what you get with a paid account, but you can buy one. Otherwise, just open a free account. For my in-laws, I told them to just buy the indices, or get into like some ETFs, XLF, XLI, that sort of stuff. Because for a 5-year plan or a 10-year plan, 15 years, if all they're doing is just allocating to the indices, they'll be fine. Munger was right? Or Buffett, whoever said just buy the indices. You'll do better than your retirement account, which is in bonds, by the way. But you know, they're getting like 4.5, 5%. It's That's not even beating SPY. You might as well just buy SPY. Double what your retirement account is getting for a typical corporate retirement account is what I mean. Your 401k. So I haven't gone in and fixed that because I like these names for the long haul. Whoever wins the quanting game, and whoever leads in drones. And apparently this is getting AI because they're offering agents now for your portfolio. If you guys are into that. I haven't run any agents, so I don't know. Marziti, have you run any agents? In anything, the agents on AI, those. It is kind of scary to think that there'll be something like that just running our lives. Hey, when you're on the Bullish Bears website and you want to see all of our affiliates, didn't we have a web page that had all of that? Discounts. That's what it's under. So the question about the different platforms and things that are out there, if you want a hit list, and this is not a modern hit list, unfortunately, we haven't added to this in a while, but there's usually a video to the names that are in here, like Trade Idea video, um, Trend Spider video, Flow Trade, blah blah blah. So I know that's not great because of all the new tools that are out there, like Market AI and all that stuff. But there's that, and then there's just searching for the name of whatever product that you want to see if we have a video with, and use the words Bullish Bears in front of it. So like Bullish Bears Trend Spider. And if we have a video, that should bring it up. Should. But Lucian did series for a while. Like he did entire Think or Swim video series, and then E-Trade. Um, not I don't think he did a Schwab one, but there's another one that was he really liked. I can't remember the name of it. He probably did an IBKR. He would be a good one to ask, by the way, about getting that list put together that you were asking about. I would ask Lucian. not Kevin. I would ask Lucian because he likes that kind of video stuff. I bet he, if anybody would be wanting to do it, I bet it'd be him. The quantum breakthrough, is that what you mean? So this theory about putting AI in space, that seemed a bit hyperbolic to me. Has it got any merit? So we'd have to hide it all on the backside of the moon and then figure out how to talk through the moon. The options volume or the share volume or both? If you notice earlier when I wanted to look at volume, I went back to Thinkorswim. There was a reason for that. Um, I believe they don't have options volume for you to sort through. When right, that you can get like you can add volume to your column right there, but you can't see time and sales, right? What I use time and sales for is to be able to see, did they buy to open or sell to close or buy to close or buy to, that I'm looking to see, was the order an opening position or a closing position. And time and sales show me the bid and the ask, and I can see how the trade was ordered. Was it hitting the bid and below or the ask and above? And then I infer from that that they were buying or selling. But it's not a perfect world, right? That's options in general. And without that, if I come in and I look at, say, Schwab, and it shows volume of 517 contracts, I don't have a time and sales to be able to look and see, was those bought to open or sold to open, or what was it? I just see that there was 517 contracts traded, but I don't know anything more than that. And there's no way to tell on their platform, as far as I know. No, you make a very good point. With that in mind, you don't need the time in sales. The time in sales is going to help you try to better analyze specific options volume that was traded for that day. And I don't, if I'm looking at holding stock and I want to use options to enhance that stock trade, I don't really dial into that. Well, I only use that for like unusual options activity and that sort of stuff. What you need to focus on for your needs would be open interest, and if it has any volume, whether it was buy to open, buy to close, who cares, as long as there was volume there. And you can, right. you're good. You don't need the time and sales of the options themselves. That would be for more UOA, unusual options activity. So as long as you can find high open interest and um, some viable volume, then you're good. And by viable, I want to know that I'm not the only one trading it and that I'm not the one who's making book by doing it. So high open interest is a good indication that I'm not alone. I'm on Schwab for June 18th of 2026, and there is no volume in here, really none at all. But look at the thousands of contracts that are being held open right now. So I'm not alone. And I know that they're going to have to exit those, which will provide liquidity as we get closer to expiration. So when I come in and I look at closer to expiration, there's hundreds. That's not awesome, but there is activity on the volume. Thousands of contracts are being traded on the put side, um, hundreds on the call side, closer to expiration. I would feel okay protecting my stock trade with these options because it's viable. I wouldn't want to trade just options on Schwab, but BALC, BARC. I got nothing. Any, what's the ATI? No, UTI is Universal Technical Institute. So earlier I ran through bank stocks. These are for the ETF KRE. That's your banking ETF in the US. None of these do, right? Like I started the stream today looking at, so KRE. We'll just bring up KRE. Um, you might find enough to buy the stock, but definitely don't use these options for the trade itself. Right. So here's KRE, and we can see open interest is in the thousands for April, May. For the OPEXs, there is liquidity. So same argument as the other one. There's enough here to protect my stock trade. I'd be willing to sell a call or sell a put to protect my shares, but there's not enough in here to make me want to trade just the options without the stock. Yeah, if you're trading the stock and you want to sell a put, yeah, you could do that or sell a call. Sorry? Right. Yeah, these are illiquid. So if I was looking to speculate and buy calls or buy puts, none of these banks fit that bill. Not for just the bank names, but if you wanted to get into something more popular like um, Goldman or JP Morgan or Citibank, one of those names are not necessarily in the banking list name. They're more like capital markets or, when I go to financials here, industry, financials, there's banks. And we were just looking at the top names in the banking space, but there's financial services, consumer finance, capital markets, and JP Morgan, Goldman Sachs, USB, CME, ICE, those are capital markets. So in the capital market space, if we start looking at some of these, that's what I was going through when we came across Schwab. Goldman didn't have much, or no, Morgan Stanley. Morgan Stanley didn't have much. Goldman sucked. BLK was the next one behind Schwab. It's got weeklies. That's a good start. No volume in there. Nope. Um, Plus, I don't know if you caught this, that banks are going to have earnings in the next 2 weeks. They're going to be kicking off earnings. So if you're looking for any trade in financials at all, anywhere in the financial space, you're going to run across earnings, and that's a big risk, right? You're going to have to be starting your trade with the idea that, oh man, we're just about to start a whole new earnings cycle. First, banks are going to kick off, and then we're going to get the Mag 7, and then other software behind the Mag 7. Everything out there is about to run through earnings. And typically speaking, in earnings season, stocks just kind of drift sideways until we're done. Unless banks have a bad earnings, then stocks are going down. Or if banks and the Mag 7 have a blowout earnings, possibly we could break out and rally. But generally speaking, during earnings, stocks just go sideways and wait for earnings to be done. So that all those, yeah, short term, right. There's a lot of videos on YouTube that make it sound like we can just trade dividends because of how much dividend we're going to get. And yeah, what I recommend to people is have a list of stocks that you want to be associated with. And then after you have that list, see which ones have dividend that might sway you when you're choosing between one name or another. Well, no, you actually said it differently this time. You said use the options to get the stock. No matter how illiquid it is, if you eventually want the shares, by all means, sell puts on it. I don't care if you are making book. If your goal is to get the stock, you can certainly sell puts on it. You absolutely When it comes to options, the reason we argue that people want liquidity is because A, it's going to affect how much money you get in credit or how much you have to spend if you're buying the option. But on the other side of it, it's we want to make sure that people don't get assigned shares or get short hundreds of shares and then they can't cover that and they blow their accounts up. But when your goal is literally to get the stock, no matter how illiquid it is, you have no threat, right? Because exactly. The the other benefit for you is even if the stock doesn't cross your option and you're not going to get assigned, you can let it go all the way into expiration and get max credit every time. So you don't even have to worry about getting out, right? Like that's the sweet spot of options trading that you have no risk. All good. So with that in mind, what a lot of YouTubers recommend, you want to throw in the trash because they're going to recommend going out into the low deltas, like a 10 or a 12 or a 15 delta, and there's just no money out there to begin with. There's no way to defend or protect those trades, even though you wouldn't need to, but there's no money in it, right? That's the main takeaway is going that far out to get that low delta stuff that they always recommend. They recommend that because they think it's quote safer. You don't have a safety issue, so Forget that. Plus, there's no money. I like to sell near the money. So 35 and higher, 35 delta, 45 delta. I've even traded them in the money from time to time, as long as I've got enough distance from expiration, because you can get early assignment and that can just be frustrating. But your goal is to get some credit and eventually to get the stock. So don't hesitate to trade near the money. They will be more liquid, so you'll be able to get in and out of them easier, at least into them. And you very likely won't have to make book to do that. So near the money to me is just the better proposal. YouTube does not. No, but no matter what kind of sell side you look for on YouTube, inevitably every video I ever find is, "Oh, you're selling options, you should go out into the teens." Forget that. Fee. Yep. when I s- when I first started options, yeah, when I first started options, the trade small, trade often mantra from Tasty was my T-shirt. I drank the Kool-Aid. So I had a very small account and I only really knew one strategy, and that was the vertical. So I was doing a lot of vertical trades. My goal was 50 cent wide verticals. So a lot of times in the live streams, I like to use XLF because it has 50 cent wide verticals and it just makes for a great representation of the trades that I was doing back then. But I would go through the Dow Jones when I got bolder and moved away from the 50 cent strikes. I put them in alphabetical order and I would go through the whole list one at a time and I would build a vertical on it. It didn't matter to me, long, short, I don't care. I had a stock, I had a trade on every one of them except Travelers because Travelers didn't have weeklies. I bet it still doesn't have weeklies. So in the Dow, it was the only one that had no weeklies. And it didn't matter to me if it had decent liquidity or not. As long as I had a weekly, I was putting the vertical on after I got done with my 50 cent wide verticals. Every one of these, I had a name, I had a trade on it. I kept it as small as I could, and I was using their criteria. So I'd go out 30 to 45 days, and I was randomly choosing based on had we been falling, okay, I'll go long. Had we been rising, okay, I'll go short. That was about all I had because I didn't really know how to do technical analysis when I started. I learned options and then I learned how to read candles. It sounds completely backwards, but I I wanted to get into it now and start making money now. I didn't want to wait 2 years to learn how to trade before I started trading. And I Yep. No. No, margin just means that you are margin approved, but you don't actually have to use the margin. And as long as you pass whatever background they do on you to say, are you margin approved? That's it. Kind of. We say correctly that yes, it needs to be between 9:30 and 4, but that is changing. So maybe by next year we'll give you a different answer. Right now, we'll just stick with yes, it needs to be between 9:30 and 4. It's dangerous. When it comes to options, the margin question, one, I was taught don't use it unless you absolutely are comfortable with what you're doing. Don't use it. You're using borrowed money and the trade can lose and then you're really in a pickle. On the other side of that, when an option trade gets placed, they evaluate it and they don't need all the margin depending on what broker you're using, right? So they might say that's a $10,000 trade and we're going to ask for 3,000. So you just keep that 3,000 there, everything will be good. Well, if volatility hits, bad news, whatever, suddenly they're going to come back and say, we was only asking for 3, but now we're going to need 5,000. So exactly. But I just wanted to throw that out there for anybody else that was listening, is that the margin requirement is on them to decide the level of it, and they can just randomly decide, hey, you know what, we want more than what we wanted before. And that's true for futures traders too, right? We trade futures. It's a different kind of margin, but in futures we just call it buying power, but it's the same thing, it's margin. And that buying power requirement can change. They can say, well, we did only need 25%, but now suddenly we're going to need 50% of that contract's value. The, and the For yep, for verticals or anything beside a long and a long put and a long call, if you want to do anything beyond that, you're going to need to have margin privileges. And I've had clients tell me I'm never doing that kind of trading because I don't want to deal with margin. And no matter how much I tried to explain to them, they don't need to use the margin. They just need to have the ability, right? Like it's just a box that gets checked that says I have margin privilege. Check that box, and then you can do whatever options trade that you want to do. In reason, you can't short like naked calls, but you can do your verticals, butterflies, iron condors, because you have the margin privilege. And that's the criteria that has to be met. Some are going to do a background check. They're going to look at your finances. Others are just going to look at your account. I was running a margin account on Robinhood with $300. I had margin privileges. Have a good one. The brokers like Thinkorswim is run by Schwab. I reached out to Schwab and asked them about their day trade rate for futures. Their buying power went up when TD Ameritrade swapped to Schwab for futures. We were trading futures here. Creed really liked trading futures here, but you couldn't really do micros because the commissions and the fees were so expensive. You really had to just use minis. That way you made enough money to pay off the commissions and the fees. But when Schwab got them, their margin buying power basically was the initial cost of the contract itself. The government says it needs to be, I think it's 16 or 20%, somewhere around that. And the brokers can choose to offer more or equal to what the government says. The ones like Iron Beam, Tradeovate, Ninja, they're in a different category. I'm talking like Tasty Trade, Schwab, Fidelity, those guys. There's two kinds of brokers. So for the Schwab group, 20% or 18%, whatever the government dictates, they can use that or they can ask for more. And Schwab said, we basically want all of it. Their goal was to get rid of retail traders trading options on or trading futures on Thinkorswim. They don't want your business. So yeah, I asked them, what's your day rate? They said, we really don't have a day rate anymore. I said, well, why? Do you not want our business? And it was just silence on the other end. Like, he didn't say it, but he might as well have. That's correct. Now, if you were on Fidelity, when you go to place the trade, it would ask you, do you want to place this trade with margin or do you just want to use cash? On Tasty, I've never had it ask me that. So watch your P&L, watch your trade when it's put on, and if you have any suspicion at all that they placed your trade on the margin side rather than the cash, call them. They have an excellent customer service. It's not one of those places that'll just sit you down and never talk to you. You're paying for it. Yep. I just looked. I didn't see a margin requirement and in the tabs to add as a column, only capital requirements. So I know at Fidelity, they will nice and sneaky and subtle. You go to place a trade and you're suddenly using margin and you had no intentions of using margin. And I've had that happen at Tasty or not Tasty, but at Fidelity. And it drove me crazy. It's one of the reasons I don't do a lot of trading there. I do like buy and hold stuff because I have to check so closely every time and make sure that I'm using the right button or boom, I got margin. I've never had that issue with Tasty, not once. So if you ever doubt just call them. They'll set you straight. But I don't think you're ever going to have that problem here. If you want margin, if you want to use a margin here, I think you actually have to take extra steps because they don't want you to use it, which is the way it's supposed to be, right? We don't want to use it. They don't want you to use it. Yeah, because that's a good question. That redheaded dude too. I don't remember his name, but I know who you're talking about. And that's why when I see people in the chat use words like scalp, I'm like, hold on, let's define what you just said so that we both agree what scalp means. And usually I get a different answer when I Google it because I usually just Google and copy paste the words. But scalp is just what Marziti said there. Very small positions or very large positions for a small move in the market done hundreds of times a day. That's a scalp. And most people that I see in the chat, they don't want that trade. They aren't even imagining that trade. They imagine something else and they use the word scalp. So that word, when I see it in the chat, always makes me pause. I'm like, you really don't mean scalp, do you? And then with a big position. So, you know, for options trades, a really good way to start is what you're doing because your risk is minimal, right? You want the stock. You're going to dabble in options as a way to get started. For directional traders messing with options, they're going to get hurt the worst. They're trying to buy calls and buy puts. That is a really quick way to lose a lot of money. Otherwise, playing probabilities with verticals is a good way to go, and it's a good way to learn. Also, it's why I usually teach verticals to people as one of the first trades to learn because you can trade it small, you can trade it often, and you could use something like SPY every day, every day, every day, which is the most liquid, and that way you never have to worry about liquidity. SPY, the Qs. If you just trade that and you trade verticals, you've got a really good start. But people like to experiment. They want to stretch their wings, get into other things. The Dow Jones is a really good list. And I would only look for the big turns, like I was mentioning earlier. I would just look for something that's been falling a lot, run it the other way, or look for something that's been rising a lot, run it the other way. And I build them at the money so that if I'm wrong, it was really easy to tell that I was wrong. None of that way out of the money stuff where you're left scratching your head about whether you should close it or not. And that way, also, your losses are smaller. I know you got to pony up more for a vertical at the money. You have to spend more money, but you get more credit on the other side of that. It's more of a one-to-one trade and less of a risk four to make one trade. So you get a better loss when you lose. I mean, nothing better about losing, but your losses don't hurt as bad. Your profits are much better. You can easily identify that the trade isn't working and just get the hell out and move on to another trade. So that is like the best place to start in the options world. Verticals at the money and just big turning points, all-time highs, deep lows. You can use something generic like a 5 bar rule. Hey, we have 5 red bars in a row. I'm gonna go green. I'm gonna go long. All right. 5 green bars in a row. I'm gonna go the other way. It's generic, but it works. You don't have to be some sniping quick shooter that is textbook perfect on their entries and exits. You can be sloppy, slow, get in a little late. With options, it doesn't matter. You just let it ride, let it bake. And if you're on the sell side, more often than not, if you trade it that way, it is not going to be punishing when you're wrong, and it's going to have decent rewards when you're right. You move on to the next trade and the next trade and the next trade, and then you get to grow from your experience. Start rolling them, adapting them, protecting them, all kinds of things that you can do to an options trade that make them favorable. That's their benefit. It's what makes them so awesome. But we have to start somewhere. So I think either starting that way or what you're talking about is two really good ways to start in the options world. For anybody listening, don't start with buying calls and puts. That is the quickest way to lose money. Here's an Here's an Amazon call for April 17, 16 days to expiration at the money. It's $645. Now, if I buy this call, it's the 210 strike. I'm paying 645. My break even is 216.45. If Amazon doesn't get there at expiration, I will be losing money. I'll lose all my money. If it gets only there, I break even. Anything above $216.45, I start to make money. So this stock is going to have to move $6.50 just for me to break even. Now, somebody's going to hear me say that and say, well, why hold it to expiration? if it makes a quick, fast move, the stock is going to rise, the option will increase in value, and you can get out for some money. Sure, I could. If it moves $2.50 today, well, tomorrow I could, what I bought for 645, I could sell for 780. I made $1.25 ish, right? Kind of rounded a little bit. I barely made a buck 50. The stock moved 250 pennies, $2.50, and I barely made a buck 50 out of it. I had to spend 650 to make $1.35, and I needed a big move in the stock to get that done. That's a 1% move. The game's against you. On the screen, I highlighted here um, a vertical that's way out of the money and a vertical that was in the money. And I did this to highlight the buy side. Don't buy, but also I guess don't sell. This out of the money vertical, if I if I just buy a call at the 227.50 strike because it's cheap, it's out of the money, and I think Amazon's going to go up, and I only want to spend 65 cents. Suppose they fill me on the bid, which is nuts, but so what? Let's say they do. So I buy this call at 65 cents, and I'm thinking, so what? If Amazon goes up, I'm gonna make me some money. It goes up $2.50. How much did I make? 30 cents. 30 cents. And it's going to have to make that move in a 1 day move. That's how much I'm going to make. Wow, that sucks. But if I bought a call in the money or at the money, the 207.5, I spend $7.80 for that, and we move the same $2.50 tomorrow, I'll make $1.80. So if you're going to buy a call or a put, don't buy that far out of the money trash just because it's cheap, because it's a sucker's bet. You're going to need a really big move, or you're just going to lose that money. If you're going to buy the long option, buy it near the money, at the money, in the money. Get far enough out in time so you don't get assigned because you bought an option in the money. But you can see that that same $2.50 move gave me a $1.80 profit or a 30-cent profit, depending on which call I bought. So if you're trading options, a stock position like this is going to look very tempting, where it starts out in the morning deep red, and you think, "Oh, I'm going to buy puts." Be very careful. Most of those don't stay red all day, and they don't just fall, fall, fall. Most of the time, we're going to get a intraday flip. I don't buy calls when we're green and moving up. I don't buy puts when we're red and moving down. And it's because of the options value. The options value is highly manipulative, highly manipulative. So if you want to put, get a green bar. It doesn't have to go up 5 or 6 green bars, but if it's falling and falling and falling and you want in and buy a put, get a green bar. Even one bar will help you avoid the extra slam that you're going to get if the trade is wrong. You can't help getting a losing trade. We all get losing trades. There's nothing you can do about that. But the immediate loss that will come if you buy it red and then you're wrong is going to be much, much worse than if you're get it even one green candle and then you turn out to be wrong. The loss will be a lot less. So one thing that you can do on Thinkorswim that's really cool, this will help anybody who wants to day trade options, is bring up the option that you want to trade. Don't trade it, just look at it. Watch what its value does as the stock falls. So this is a put. This is the 210 strike put for April 6th. And I'm looking at it while I can still see the stock chart. So I got Amazon here and I got a put. You want to watch the value of that put as it's falling and then see one green candle and watch what happens to that option. You don't have to trade it. You just get to see how the value changes in it because that is what you want to take advantage of. Even if you're wrong, it's going to help you and you'll get to witness it, to visualize it, to so that we can all absorb it. I'm a visual learner. I kind of need to see, put my hands on it, grapple with it. That gave me the ability to do that. So find a way to chart it where you can see that options price. Detach your chart and go to the trade tab if that's what you have to do. Just have a way to see what's happening to that options value and then look for the opposite candle color to come in and see how much the options value gets whipped. The best one to use in this example is the SPX. And that's because the rate of change in the options price is more violent in this product than anything I've ever seen in my life. Now, you occasionally find like GameStop having a wild day or it happens that other things move faster. But on any given day, I know I can bring up the SPX and see wild price movement. So bring up the SPX and watch the options price as the SPX rises and rises and rises and gets one red candle. Watch it, watch that options value, or two red candles on a green day, and vice versa. If we're falling and falling, get one or two green candles, see what happens to that put. That trick, if you want to call it that, is a really good way to reduce how much your loss is, especially if you're trying to be diligent and you're going to kill the trade quick. If it starts to go against you, you won't be able to kill it quick enough. You will take that initial punishment unless you buy puts on green candles and you buy calls on red candles. And then you're sitting there and you're watching it and your fingers on the mouse and you're ready to kill the trade. You'll lose less. I promise you, you'll lose less. Just use the opposite candle and you can watch it and witness it and kind of get familiar with what I'm talking about so that you can grow into it. It is an amazing thing to see. And once you see it, you'll never be able to unsee it.